In this video, I'll be discussing the biggest trading mistakes. There are some traders out there who have done the unthinkable. They've turned nothing into something, completely changed their lives. While 99% of the market lose money, some people just can't stop winning. In this video, I want to talk about the trading rules which have helped some of the greatest traders you might not have heard of consistently outperform the market. Now, before we get into this video, none of this is financial advice. I'm not a financial advisor, and everything on my channel, everything in this video is for entertainment and educational purposes. This is to educate you as a young up-and-coming trader to have success in the markets. Our first trader, Jesse Livermore. Growing up as a young boy when the stock market was pretty much invented, he managed to turn as little as $5 into over $1 billion. And in one key instance, JP Morgan himself supposedly sent him a message to tell him to calm down because he was in control of the entire market. Often called the boy plunger or the great bear, Jesse Livermore is one of the greatest traders of all time. And as somebody who made an insane amount but also went bankrupt multiple times, he followed these key rules. Number one, trade only when the market confirms your idea. It's quite often we can get caught trying to catch a falling knife or be a breakout trader, and that's where 99% of traders get wrecked. Another one, cut your losses early and let your winners ride. You might have been in a trade before where it's hit your entry perfect, but something just causes you to close early. Maybe it's the macro market. Maybe it's what somebody's saying on crypto Twitter, or maybe it's just your gut instinct giving you that nervous feeling. But Jesse Livermore learned the hard way that it's important to simply let your winners run, to never average down your losses. He quite often said, in today's terminology, a loser will always be a loser, and your winners you should double down on. The next, trade strong names, and a lagger will always be a lagger. Sometimes you might see a major stock outperforming the market. You start to go look for beta plays. Maybe in the crypto world, you see Bitcoin breaking out. You decide to start looking for all of the beta plays. While that play, which you're holding on to, does absolutely nothing, Bitcoin or even that stock continues to outperform and dominate the market. It's because a winner will always be a winner. And a loser will likely always be a loser. And the final one from the legend Jesse Livermore is the market is never wrong. Only your bias is wrong. There's been many times myself where I found myself questioning the market. Or the market makers shook me out, or are the cabal are pushing this token or pushing this narrative. Well, it's quite often that the market wasn't wrong. It's simply your bias was wrong. And when you find yourself in that position, instead of trying to bet against the market, take a step back, look at things unemotionally and see whether the trend might actually be changing. Next, we have Richard Wyckoff, a man which you've probably heard about because everybody trades his patterns. The Wyckoff pattern, supply and demand, accumulation and distribution. It's a pattern which has been traded across the entire market, and it's actually one of my favorite patterns, especially for finding undervalued tokens, undervalued stocks. His rule number one, of course, related to his famous charting, is be able to identify accumulation and distribution zones. One thing which I go over a lot on my channel is being able to spot when tokens are being accumulated and when things are being distributed. It's quite often when we see something which is hyped, it's all over social media. Everybody's telling you, oh, have you taken a look at this? We might have seen more recently Zeta, or if you're a gold trader, gold, and people queuing outside of shops to purchase gold. Well, why is that? Why is that the masses always seem to come at the top, yet the greatest traders tend to be in at the bottom? But that's simple. They accumulate when it's quiet. They accumulate when nobody's talking about it and nobody's interested in it. In fact, sometimes even media at the time is bearish. Media is saying that it's so over. The media has multiple investors come on the news network and speak about it, and sometimes even interrogate investors based on their decisions. But then when things become bullish again, when things become marked up, like the markup pattern, well, social media becomes bullish. Everybody's talking about it. And that time is quite often when the patient are distributing to the impatient. And this is why his second rule quite often relates to the first one. And that is watch out what the composite operator is doing. Now, a composite operator is quite often what's called an insider. So instead of watching what social media says you should watch where the smart money go. There are many smart money tools which you can use. If you trade in meme coins, you can use GMGN. If you're trading crypto, you can look at open interest, for example. You could even look at hyperliquid and see where the hyperliquid whales are getting into. And if you trade in stocks and commodities, you can see what the big investment funds are investing into. You know, we've seen AI be the major wave. But what comes after AI? And we know that data, well, what is data related to? Energy, right? So we start to see all these different industries related to it. And while everybody is chasing the big AI boom, the smart money might sell that and they might rotate to energy. Right, so there are many ways to follow the smart money, and instead of following your favorite crypto influencer, like even myself, you should probably be looking on chain and looking at what the smart money is up to. His next one is quite technical. It's buy after the test and sell the up thrust. Now this sounds confusing, but I'll lay it out for you in plain English. You want to buy on a retest. A lot of people try to catch a breakout. They try to be a breakout trader, but that's because of their fear of being able to spot clear support resistance zones and spot when a chart reclaims that zone. Recently, I actually caught a $4,500 trade doing this exact strategy. I caught a pump fund trade. We caught the dip on pump fund, and in about 20 minutes, I made 4.5 grand. And that was simply by spotting a key area, waiting for that position to execute, and selling when it runs up. Most traders get caught at clear levels where they think that it's perfect, but they haven't waited for the chart to prove it's first. I've been in those trades before, and I'm sure you have too. And that's why his next one is wait for confirmation. You don't have to be on the 1 second chart, the 15-minute chart, the 20-minute chart. Sometimes you can zoom out. You can wait for a 4-hour candle close, a daily close, a weekly close, because at the end of the day, once there is confirmation of a trend change or direction, it's clear where the chart's going to go. And finally, volume. Wyckoff was a visionary of his time, of course. But one of the things that he was mainly passionate about was price action and volume. Those are the two key things which he followed. It's the same thing if you trade in crypto and meme coins. Hold account on volume is most important. It's the same thing on whatever chart you're trading, even in macro markets. You simply want to wait for a confirmation of volume. If there's a breakout on low volume, it's probably not a good breakout. If there's a breakout on high volume, it's likely there's a confirmation that that's going to continue in that same trend. We see it with Bitcoin. When Bitcoin came down to around that 75K region, when it was at absolute bottom, most people were calling for a bear market. Anson was tweeting, you know, we've seen a double top like last cycle. But it turns out we completely reversed and we ran back up to all-time highs. Well, that was clearly because that trend change was because of high volume. It was a confirmed breakout. And now I have two more very special traders for you. The next one is more recently. RIP to the man. He's an absolute legend. I only actually recently discovered his teachings and his seminars and his lectures. But this guy is an absolute legend. It actually gives me goosebumps speaking about this thing because I've been on a trading journey myself, like you have, which is the reason why you should pay attention. Because David Paul is an absolute legend of the markets. A man who took his time out to meet other people, to study the industry, and to lecture thousands how to become a profitable trader. And the guy knows how to say a joke.
The next time you're just about to put a trade on, you pick up something heavy and you just go, poof!
His system was simple. Price action, emotional control, and probabilities. These three things is what's allowed him to create these rules, which he followed without fail. Rule number 1, protect your capital at all costs. There's been so many times inside of my community with over 20,000 people, which I hear the words, oh, I'm full ported, or I'm all in, or this has to work, or please praying to the gods that this trades play out. Now, most of the time they don't. And it's actually worse when they do. There have been many times where you can make a degenerate play and get lucky, but that luck only lasts so long and it becomes addictive. Most funds like BlackRock, etc., they pride themselves on protecting their capital because they know when the time comes, when the opportunity comes, you better have your money ready. Next, only focus on high probability setups. Think about it. You don't need to make money on every move. You simply need to make money on the right ones, the big ones. His third rule, risk small enough to stay unemotional. I've experienced this myself. I've been in multi-million-dollar trades, up, nights on end, endless, barely sleeping, because I was overexposed to the market, waiting for that margin call, waiting for that email that we all love to hate, and kind of knowing what you're destined for. It's a kind of weird balance, risking just enough where it feels good when you win, but also not risking too much so you can still play the game. Similar to poker, you can't play when you got no chips. Now there's 3 more rules. The next one is very interesting. Avoid the chop. You don't want to trade in choppy ranges. These ranges are designed to take your money. You want to wait for Wyckoff spring patterns, for example. You want to wait for value area lows. You want to wait and enter where other people's stop losses is. You want to wait and enter where other people's stop losses are. At the end of the day, it's the game of making money. And if you're playing the game like everybody else, you're trying to make money off every move, you're getting caught in the chop, then quite simply, you're just going to get wrecked. Next, trend plus the trigger plus stop. Kind of links back to pretty much his whole strategy. To be honest, this is kind of a formula for success, because if you put all of them together, you trade less in the chop, you trade with a little bit less money, then it's going to have you emotional, you're going to be stuck in the trade. Then you can wait for the trend, for a trigger, a stop. You can wait for, like I said earlier, a Wyckoff spring pattern, for example. And finally, linking to the patience, linking to the formula of David Paul, is simply taking fewer trades. You don't need to be in a trade every single day. You don't need to make money every single day. Most major traders outperform people because they are patient. And when the time comes to play, they know how to play ball. Similar to poker, as I mentioned earlier, something which I love, because poker represents trading. A lot of professional poker players are good traders. A lot of professional traders are good poker players. It transitions perfectly. And there's a style in poker called tight but aggressive. It's a style where you play less hands, take less trades. But when you take a trade, you have high confidence in it. Most people cannot stomach this style of play, because every morning they feel the need to be in a trade. Their trading account is always active. They're always in another position, either long or they're short, and they look back in hindsight and say, oh, well, what if I was in this position? Or imagine how much I would have made off that move. Then you look back at the end of the month, they haven't made any money. Whereas you look up at the other traders who only take 1, 2, 3 trades a month, they dwarf these guys that have been trading every single day, sometimes staring at a screen for 8 hours. Now, stay with me here, because we have one last trader. Last but not least, the legendary trader. The man famous for sure in the 1987 crash and labeled one of the greatest hedge fund managers of all time, Paul Tudor Jones. His number 1 rule, similar to the other guys, would you be surprised? Never lose money. Your focus, instead of being worried about how much money you're making, it should be worried about how much money you're losing. Your goal should be to preserve capital, simply not lose money. The next one, losers average losers. Now, it's a crazy mindset shift. It's something which recently I've had this mindset shift as well. I would normally average down a position. It seems quite normal in the market. You're in a position, your liquidation gets close, you don't want to hit your liquidation, so what do? You average down your position. Instead of doing that, these traders, the legendary ones, the guys that have made real money in the markets, they don't do it. They never average down a losing position. I'm sure you've seen it recently, especially if you trade crypto. You've seen hyperliquid whales. You've seen the James Wins of the world. Now, why is it that even though sometimes they will make astronomical gains, hundreds of %, millions of dollars, why is it that they always go broke? Well, it's quite simple. They end up in a position which they can't let go of. They end up on the wrong side of the trend. And without letting go of the hand, they decide to go all in, knowing that they don't have the highest probability of success. And they're losers, average losers. They liquidate the whole entire account. They go broke. His 3rd rule, look for big risk and big reward. Now, it's a little bit different to other people you might have seen, which even other legendary traders which put out there. They say they don't risk that much money. But Paul Tudor Jones says, take big risks for big rewards. So maybe instead of averaging down your losers, picture how much money you would probably save from doing all of that, and look to take big risks and potentially make big reward. Not financial advice, obviously. It's Paul Tudor Jones's theory. Now, the final 2 before we close off this segment, simple. Respect momentum and no ego. Cut it quick. When there is momentum, you have to respect it. And trust in yourself. Recognize your points where you might have too much ego and cut it. Cut it quick. There's a lot of times, me personally, I'll always say, I personally think social media wrecked James Wynn. I think he was a great trader before social media. But once ego gets into play, especially when you're dealing with large positions, you don't want to be wrong. Even sometimes you might be speaking with a friend. You tell your friend, oh, I think this token could do very well. You feel like because you've said that it can do well, you have to make money from it. And then you end up in this position of trading against the trend, trading against the market, and being completely wrong. simply because of ego. So I wanted to map out these legendary traders, each of them a legend in their own right. Throughout the entire of history, these names will go down in history. In fact, they already have. In some instances, years later, their names echo through the history books. They echo through traders. And as you grow as a trader, you will understand that the rules that I have given you are probably some of the best rules that you'll ever hear on YouTube. It's something which not too many people speak about. They speak about going all in. They speak about full point. You know, and everybody's always hyped about certain investments at the top. But that's quite simply not where the money is. The money's made when it's quiet. It's made by not necessarily risking too much, by following the trend, and by letting go of your ego. And these rules, personally, you should write them down. I've written them down. I have them in my book right here. And I study them every single day because the market has a way of drawing you in. It has a way of getting you emotional. And all of a sudden, before you know it, you've forgotten your rules. You're back in the casino. But that's not the goal. The goal is to treat trading like a business. And if you do want to treat trading like a business and you want to join other people who are having similar success, check out the link in the description. You can join the trenches. Otherwise, subscribe to the channel. If you like these new style of videos, it's a new, fresh style, comment down below and I'll make more of them. Personally, I love this style of content. I love studying trading. I love studying the greats. And this is a new journey for me as well. So I appreciate you guys. Thank you very much. I'll see you in the next one.